We're back for another Meetup Group.
Yo,
What's
dude,
up,
I'm
Ian?
starving. It's like whatever time at night. I haven't eaten dinner. I'm dying, dude. I'm wasting away to nothing. Look at me.
You're not wasting away to
Normally,
to
we used to do these
anything.
things in person. I would be able to order a beer, a tequila,
Well, sorry.
a vodka. Okay,
You want to get a Bud Light out of the fridge?
dude, I might need to. I need some carbs. I mean, are we allowed to drink vodka right now, or is that a touchy subject?
I drink Tito's, so it's
Oh,
not.
that's American made, so we're good. Yeah.
So it's not touchy at all.
Yeah.
All right. So I know we normally bring in guests to our Meetup Group, but you've been traveling a lot. You've got a lot of deals that have been going on. I feel like we should talk about some of these deals that you're in the midst of related to. I know you're heavy on operations right now because that's where it is. But since we've last chatted, you've acquired properties, you've raised a good bit of capital for it. Instead of bringing in a guest, we got our own co-founder of the Meetup Group, Ian Horowitz.
Yeah.
So we should just kind of have a candid conversation. For everyone watching, just so you know, we actually have the whiteboard cam here today. So we're going to use that whiteboard cam to have to part of this.
It makes me look like a giant.
If we need to. If we need to, yeah. Let's look at Ian on the whiteboard cam.
So we're ready to go.
Perfect. So if you're just tuning in, welcome to the Meetup Group, the March Meetup Group. Looking forward to it. Feel free to ask any questions in the comments. We'll try to get to all of them as soon as possible. So enjoy yourself for the next 45 minutes, and we're going to do whatever we can to provide as much value as we can related to real life real estate today. So, okay. So let's talk about some of the deals that you've been working on. How far back do you want to go?
I think most people know me by now that I'm an open book, right? So, I mean, you know a lot of the deals that we're working on, have worked on, what we're trying to do. What do you think would provide the most value to the audience? Because we've done a lot of capital raising, we've done a lot of debt financing, we've done a lot of deal acquisition out of state, commercial deals.
Okay, well, I think we should break this into three topics. Let's talk. Let's spend a little bit of time on how you found the properties, how you financed the properties, and what you're doing currently operational. So, pick one. Which one do you want to start with?
All right, let's start with like finding deals.
No, but like a deal. I'm saying, like, let's talk about what deal and where you found it.
All right, let's talk about Baton Rouge, right? Because that's
a good
clearly the biggest deal that we've done to date.
Let's concentrate on Baton Rouge tonight, actually. So, define the portfolio size, what the total purchase price was, what your CapEx was, what your long-term play was, how much money you had to raise, things like that. Let's just start with that.
Okay, so we purchased a 3-property portfolio. You can find some videos on Instagram and YouTube about what we were doing. But we purchased a 3-property, 250,000 square foot self-storage portfolio in Baton Rouge, Louisiana. And to put that into like scale of size, the big like climate control facilities that you see, they're normally like anywhere from 70 to 100,000 square feet. We bought something along the lines of like 15 acres worth of land inside of Baton Rouge. The total purchase price was $11.1 million. We raised roughly we did raise $4.5 million bucks, and we got an $8 million first mortgage. And we're going to do about $1 million of CapEx to those properties.
Why don't we write that on the whiteboard real quick?
Okay.
So we can see it. All right. So Ian's going to write that on the whiteboard. We're going to go through purchase price, just so we can use this as a reference throughout tonight. So it was a 3-property portfolio in Baton Rouge.
We're still working on this.
Yeah, you might not be able to hear Ian. He's off mic, but no big.
Purchase price was $11.1 million. Cap raise.
This is a good one to share with everyone tonight because this is a big project, and this was Ian's biggest project as well. So, as far as I'm concerned, there's no excuses. He was able to do a project like this was significantly bigger than he's done before. Is equivalent to somebody just buying, their first townhouse maybe for $100,000. This was way more work for him. So 11.1 purchase price, $4.5 million. He raised $1 million in CapEx. What was your mortgage?
That was $8.125 million.
Yeah, what's approximately your monthly payment? You just estimate. The reason I have that is, it shows the big, the big balls you got today with,
is it balls, stupidity? What is it? Right?
So it's $38,000. So it was $38,000. Let me go back to this. It was $38,000 a month in a monthly payment, and then what was your pref that you paid your capital investors?
8% on that 4.5. So that's was that 360? Another 30? No, that can't be right. 4 or 5 times 0.08 divided by 12. Yeah, 360. 30,000 a month. So our nut's $68,000 a month.
Wait. Say that again. Write that.
Our
down.
pref.
Write that down. That's a good. Take it to the whiteboard. So So 68,000 total is how much you have monthly.
Yeah, between debt and pref service.
Woo!
Any expenses, property management, taxes, insurance, any of that
All
other
right.
good stuff.
So we'll use that whiteboard as a reference. So let's talk about how you found that deal.
It's actually it's really interesting. So there was a property that was trying to be someone else was trying to wholesale. It kind of got a little sideways when I started doing my due diligence on it. I saw that it was listed, so I called the broker only to verify that this gentleman had it under contract because of what was being transpired to me. And this kind of relates to last week's podcast of having good quality wholesalers, is that it wasn't being transpired correctly. And I was like, oh, dude, something's not right. So I tracked down the broker, verified that everything was in place, and I got talking to the broker, and it just kind of formed a relationship, just bullshitting with the guy. And actually, the broker kept following up with me. And, just kind of telling him about what we do, what we've done, who we are, kind of selling yourself, right? Like, and I think that's something that a lot of people forget is that, like, everyone's like, well, how do you find deals? How do you find money? Is that it's like I pick up the phone and pound the phone and talk to people every day. Am I a lead gen guy? Fuck no, that's not my go-to. But going out and talking to vendors and saying hi and everything, that's where I seem to excel. And so that broker called me up one day and said, look, I got this pocket listing. Guy won't let me take it to market. If I took it to market, I'd probably sell it for $12.5 million. He wants 11. That's his hard-nosed number. I'm bringing it to you and one other guy. And I was like, why are you bringing it? Why are you bringing it to me? So literally that night, I underwrote it. Called him back the next day and said, yeah, dude, we'd be a player on this. And he said, okay, cool. There's one other guy that wants to offer on it. If you could do 11-1, I'll give it to you because I don't like the other guy. Like the other guy's very reputable who was going to buy it. He goes, I just hate working with him.
And what's great is that happens every day. I think a lot of people think that that's not the case. And it's like, oh, well, if he puts up more money, we got you play the bidding game, but that's not the case. It's a relationship game, and you were able to discourage, especially in bigger deals.
Yep.
Because guess what happens? Somebody puts us under contract. They put a 90-day close or 120-day close, and they can't get to the table.
Yep.
Like that's a mess. That's a mess. So okay.
Well, it's also a big difference in commercial real estate versus single family real estate. Is that like they could just take it back to market, toss it up there.
That's
someone
right.
else is going to
and you
bid
close
on
quick.
It. Yeah, commercial. It's very like I'm trying to get this worked out, and like I want to get to my payday. And there's like they want the certainty that they're going to get to the payday, that they're taking you down this whole road. And I think that's where like a lot of our like reflection comes from, is like being able to, I don't want to say sell that, but like giving them the confidence that we're going to close. If we say we're going to close, we're going to try to do it on time whenever at all possible. And we hit some bumps and bruises in this closing process, but it did get closed, and it was a $400,000 payday for the guy,
So let me ask you a question, and this isn't being mean. I think you can appreciate this question. You don't have experience buying an $11.1 million property. Like, what made him think that you could perform?
It's a typical story, kind of like gotten like, how'd you, it's almost like an interview, and it's like, yeah, this is why we got into real estate. This is who we are, the credibility of being firemen, the credibility of doing a bunch of single family deals, the credibility of buying a 7-unit, a 44-unit, a $5 million apartment building, a $7 million total loan. And that was one of the conversations that actually pushed over the edge, was Gaslight was like, Yeah, we just did an 80,000 square foot commercial deal. We paid 3.8. We financed $7 million bucks, and it's going to be worth 15. Right, like having that conversation with him, he's like, "Oh shit, like you're in this space. Yeah, is this a stretch? Sure,
Yeah.
but
So you use that as credibility.
yeah,
And that's where I was getting at, because it's not a fake it till you make it. You know, a lot of people are like, well, they won't sell me properties, or I can't go raise money from private lenders.
Yep.
You know, things like that, because they don't have confidence of it, or they don't have experience, and they think people will see right through them, and they will. But you got to use your past experiences to do it,
and being humble about it. Right,
Yeah.
it was like, oh, I did this. It was like. He asked me, and I was like, these are the deals we're actively doing, kind of talked to him about it, told him about some other storage deals that we've done and why we're breaking into the storage market.
God, I hate when people toot their horn, too. Like, I'll talk to people, and they'll be like, oh, yeah, well, I'm a part of this, I'm a part of this, I'm part of this. And it's like, how many properties do you own right now, and how much cash did you put into into those things?
And I've
and if the answer is none, that's okay.
Right. And when we do podcasts and other stuff, like like a lot of the guests that I bring in, and like you got to vet yourself to them. And I never feel like when you're like, oh, we've raised $40 million and we've lent money, it's never like, damn, he's boasting about it. It's like humble when it comes. There's a way to be humble when you come across to people of what you've done and where you've gone and where you're trying to go, versus being like, oh yeah, the other week I bought this, and like you're just a cock about it.
And also like Gaslight was a property, 80,000 square foot. What's that, flex space, office? What do you call that? That you guys bought in Baltimore. But before that, there's nothing wrong with being like, hey, listen, I'm because you were a full-time firefighter, now you're not, but I'm a full-time firefighter. Me and my partner Dan are full-time firefighters, and guess what we do when we're not saving lives and working our asses off? We're grinding, and we built a portfolio of deals. It started with one, got to 10, got to 40, 30, 40, 50, 60, 100, whatever it is. Like, that's what happens. That's your resume, and people see that hustle, right?
Yeah.
I mean, listen, if you're not building something and you're not trying to upgrade your assets, you're going in the wrong direction. So, like, people see that. People appreciate that.
Well, and I think that's where picking up the phone, pounding it, talking to a lot of people, going to conferences, networking. I know my wife always thinks I'm out, messing off, fucking off. But
which you are.
I am. There is some drinking that happens and dinners and everything else and golf. But you know what? Like when we go out and golf, it's like Jason wants me to golf. By the way, he's bringing an investor, and I get to talk to people, right? Like, and you're always refining. But no, seriously, like you're always refining your process. I know it sounds dumb, but it's like,
it's right.
Oh, hey, I'm bringing so-and-so with me. We're golfing. Maybe he'll invest in some of your deals. I don't know. But it's just talking and integrating and networking with people. And
see whoever you know. Like, that's where it came from. I mean, I know that you've purchased multiple deals off this broker because you built a relationship with them. I know that most of your capital investors have reinvested with you because you have a relationship with them, and you have you built a track record. But I don't think that should scare people if they don't have a track record, because there's something that you've done in a previous life, or your past life, or currently, that you're still winning on. I mean, I've been very vocal about this, but like I believe that some of the most successful real estate investors I know have full-time W-2 jobs that they like and they enjoy and they're good at, and they invest in real estate in the side. And I believe that some of those deals are the most profitable deals. They're not reliant on that deal closing. They, they're a killer in this industry, so they're going to be a killer in this other industry.
And co-sign it. Straight up co-sign it. If you're successful in your business and you're trying to buy a storage deal or whatever, any commercial deal, any deal in general. This is what I do full time. I don't know what else to tell you, but this is why I have a passion for real estate too, and that's it. And being transparent.
All right, so you found that deal through a broker who that was the first deal he sold you.
That's the first deal we closed together, even though we were in contract on another one because there was some zoning issues.
And just so everyone knows, in the commercial space and in the bigger space, it's all broker oriented. Not that you can't.
Sorry, wife's yelling at me that the kids aren't going to bed.
Keep in mind, you can't. I'm not saying you don't lead gen or self-generate deals from distressed sellers like you might in, a regular single-family space, but most of them go through brokers to list their property and to represent them. When you typically, a seller might not need to be represented. I mean, I know most real estate agents might disagree with this, and I would probably agree that you probably need someone to help represent you, an attorney or a real estate agent, especially to navigate through this on the smaller transactions. But on the bigger transactions, you certainly do. There's so many other moving pieces. So it's more of a relationship game, and having a good broker is just so important. So all right, so that was finding the deal, and it was obviously a good deal. Let's jump in a little bit to the capital side of this. So
yeah, I'm sorry, go ahead.
No, go ahead if you want to keep talking.
No,
about
I was
that,
going to say, because I know we're going to jump into the capital, but I think a very strategic point. I don't remember what the third one's execution, right? So before we get into capital, like, we couldn't have capital until we knew it was a good deal. And I know this is an underwriting conversation, but there was more just than this 24-hour underwriting. It wound up becoming a 3-week process of underwriting to verify that everything we said we're going to do while we're drafting the contract is correct, right? So there was a 2-week, 3-week run-up in that time frame that we were able to utilize to continue to underwrite to make sure that we've crossed all our T's and dotted our I's. And the capital doesn't matter. And I know you're going to ask me some questions. I hope I'm not cutting you off, but it's like we were asking questions about this because we couldn't get the capital for the deal if it wasn't a good deal, And that's ultimately...
the deal always comes first. Most
Right.
people think, like, I'm going to go raise a bunch of capital, and then I'm going to go find deals. It's like, no, you're not. No capital investor is going to,
No bank's going to give you money, first off.
And it's scary, right? You're playing the seesaw game. You have a deal, you don't have money. Maybe you have money, you don't have a deal. Like, it's a seesaw game, but that's part of it. When you have confidence that you have a great deal, and obviously you did on this, and we talked about this, money will follow you, and it did.
Yep,
And $4.5 million is a lot of freaking money to raise. Let's go back to this whiteboard, Cam. $4.5 million had to get raised.
Considering our biggest capital raise prior to that was, 1.2? So almost quadruple that. And that 1.2 capital raise was maybe all of 3 phone calls because I knew the right capital investors on that deal. But, basically triple our largest capital raise to date.
Yeah, and it worked out because it was a good deal and it was a good opportunity. And, I hate to say it, but bigger deals sometimes are easier to get funded than smaller deals. And
the bigger deal actually, if you go back to the whiteboard, that first position debt actually came easier than expected. For the most part, we went with someone that we've established a relationship with who represents a lot of life insurance companies. Had they have done a deal in Louisiana prior to that, we probably could have gotten the CapEx rolled up in there, and then that capital raise would have went down to probably $3 million, and it would have made our lives just a little bit easier. However, since they never did a deal in Louisiana before, they would only finance the purchase. Don't ask why, but they financed 73.9%. Is where their comfort level was.
They got some weird argument. And I don't think we talked about this, but why Louisiana? Why'd you even buy Louisiana?
Because we were already doing other deals in the area, and that's kind of the relation. That was going back to the relationship of establishing with the broker. I was like, hey, man, like, this is where we're operating. This is where we're looking for more deals. We have 2 small deals down there. If we can't get this stuff right, we're going to bail out of that market because I can't find anything else there. Boom, he shows up with these 3 deals plus another one. Now I got a stronghold down there. We got 350,000 square feet within almost 400,000 square feet within a 2-hour radius of Baton Rouge. Did I know Baton Rouge prior to that? No, but while operating there, I learned a lot of the nuances of it. I learned what the economic drivers are. Knock on wood, hopefully gas prices go down. And that means that American oil is being opened up. But there's a lot of other economic drivers in that marketplace. It's a capital city. There's a lot of chemical plants down there. It's one of the main highways that goes across the southern part of the United States, Route 10 and Route 12. There's a lot of trucking industry. There's the port, right? There's a ton of stuff that's going on down there that we learned about. And our lender was willing to follow us again from prior deals. They like who we are. They like us as a borrower. Like, you know what? We've never done a deal in Louisiana, but we're going to do one for you. Here's the stipulations, and off we went. So,
yeah, makes sense. So, was getting the debt hard? Like what was the process of getting the 8.125 mortgage? Getting that $8 million. It's like, how do you even qualify for an $8 million loan? Like, did they pull your tax returns, business and personal? Did they Like I don't even know. Like most people don't know. Most people's biggest loan they've ever gotten are on their primary residence.
Yeah.
You know, you got an $8 million loan on a 250,000 square foot facility. Like, did you have to personally guarantee it, or was it non-recourse? Did Dan and you have to sign? Did your spouses have to sign? Did your business partners have to sign? Like, talk about the loan a little bit.
Yeah. So, and a lot of this has come from growing our portfolio and what we own elsewhere, that we've created a balance sheet or a personal financial statement that has credibility to it that allows us to sign for this loan. And that was one of the things that we needed to do, a 50% personal guarantee. Most people would take a look at that and say, I'm not personally guaranteeing $8 million, but here I am raising $4 million for my friends and family. You're telling me I'm not personally guaranteed in this goddamn thing?
100%.
Screw you. I'm signing all of it. You know what I mean? If I fail, this is it.
So it's a 50%.
It's a step down carve out and ultimately caps out a 50% floor that basically initially we're 100% personally guaranteed it. But then as it increases in equity, it reduces or something along those lines.
Which has an increase in equity, the guarantee you don't even need any
right. That's eventually going to get wiped out.
Anyways.
Right. Yeah.
So did you have the option to do a non-recourse?
We did, but it would have lowered the leverage piece down to 60%, if not lower.
3.8.
Yeah, and that's a huge deal. Think about that. 10%, that's another $1 million on your cap raise, and it's also at 8%, right? Yeah. Versus 3.15. So my blended rate, you're talking, our blended rate's got to be right around 6% with like principal pay down and everything based on the weighted averages here. You throw that other $1 million, now you're closer to 7%. It's like, dude, like it's not even going to cash flow. Versus taking a look at this and saying, well, I could get 3% debt. I really wanted to get interest only during the stabilization period, which I was having trouble getting from them, again, because it was Louisiana and there's some goofy laws down there that did not want to navigate initially. However, this is what worked for us, and trying to get the biggest leverage piece to reduce our capital raise is what we were looking for inside of this one. Because, again, $4 million is a big nut to bite off.
What's that amortized over?
That's amortized over 30 years, but the rate adjustment's every 3. And I'd like to comment on that one because a lot of people are always like, lock up the longest term money. Well, right now, like long-term money is super expensive. I don't care if you're doing commercial real estate hasn't moved as much based on the 10-year and the 5-year treasuries. However, our mortgage broker, and this is where having good vendors really come into play, our mortgage broker said, listen, man, you can lock up 10-year money right now at 4.125. But that was the difference between cash flow and no cash flow. And I said, well, why would I take 3-year money? He said, because the 3-year curve always hovers between mid-2s and mid-3s. He's like, are you willing to take that bet? I said, well, what's my alternatives? He said, well, look, if you're 3 years out of whack, imagine what you're 10 years out of whack or your 5-year. What if you expire in year 5 and that's so far out of whack, you're not going to be happy with it? He's like, plus you're paying down more principal because your interest rate's lower. I said, well, you know what? You have a lot of valid points here that I'm willing to take this risk with you and follow you along here. And his case that he presented to me is tenfold better than what I'm doing and explaining here. But it made sense to me. And I said, you know what? And we went back and underwrote it on a 3-year worst case scenarios. And if you watch the 3-year yield curve, it's much more stable than all the other ones. And that's why we were willing to take that and play the game a little bit.
Yeah, it makes sense. So it's 3 years, amortized over 30?
Over 30.
So, I mean, at least you got a principal repayment. I mean, so some of that's going towards principal.
And every 3 years, the rate adjusts. And his whole case was like, okay, in the other sense, you're paying a higher interest rate for a longer lock, but you're not paying down as much principal as you will in this 3-year period that we have the option to refinance. Maybe there's a new lender that comes to market and they're trying to blow everyone out of the water and have cheap money. We have options to get out. The other big question was, are you going to hold it or sell it? And I said, well, I think we're going to hold it, but like, I don't know. I said, the market's really, really out of whack. He's like, well, limit your prepayment penalty, do the 3-year. And also that made the lender more comfortable coming into a new market that they didn't have to be locked up for 10 years.
So let's talk about the capital raise. So you had to raise $3.5 million towards down payment plus another, let me bring back this, plus $1 million for your capital expenditures.
Correct.
So
closing costs, lender fees, down payment money, operating capital on day one, and CapEx.
And how did you structure that with capital investors?
So we've kind of refined our operation. Same way we were doing single family stuff, is always trying to find a system that works. So what we did was we did a 65-35 split with our investors. The investors get 8% preferred return every single quarter. That's annualized, right? And then they get 35% of the upside. They get profit dividends. In exchange for that, we have very, very, very limited fees. It does cost some money to operate these things, and we personally guaranteed some of this stuff. But in the end, the fees are very limited comparatively speaking to the market. The other thing is we want to hold a bigger piece of this deal because we want to operate and do what we say we're going to do. I don't get paid until anybody else gets their 8% serviced, right? And it's what works for us and our investors. And you know what? Everyone's on board. They get it. They want to see the growth. They want to see everyone succeed, not only ourselves, but themselves as well.
You think that's a standard,
No.
split? What's the standards?
Normally the way the guys do it in the marketplace is that so there's the GP and there's the LP, right?
Yep.
And the GPs are the people who put the deal together. Normally they retain anywhere from 10 to 20% of the deal, and they give their investors the other 80 to 90% of the deal. The big difference is they're getting an acquisition fee, a personal guarantee fee, a due diligence fee, a capital raise fee. They've wiped out $2-3 million of equity on day one. So in the essence, you're overpaying for the deal on day one versus us. We're getting a very small fee to put this deal together compared to the market. And the other thing that those guys do in those other way, when they retain 20%, not only are they feeing to death on day one, they're also doing it whereas if they hit these benchmarks, they're waterfalling. So you might go from 80% ownership down to 60% because they hit some bullshit target that they set up that they know they can achieve, that they're kind of washing you out very early on, and then it never reverts back. So once they hit a 12% IRR, which isn't very hard to hit, then the equity split changes, and now you own less of this deal over the long term, So I like to know, and for us, we're simplistic guys. It's hard for me to look at someone in the eye and say, hey, you own 20%, you own 80% day one, but if I do X, Y, and Z, then you own 60%. If I do X, Y, and Z, then you own 40%. And it's so hard to calculate that shit and say, well, this is what you're going to own at this period. Like, very easy. Hey, I own X% of this deal, the end.
I mean, most people, at that level, it's getting prepared by, someone who has an MBA in
right.
in corporate finance or something
well, and they're
very
trying to
sophisticated.
And they're trying to beat the stock market, which isn't very hard, right? Like if they know that they can limit, if they can prove that their fee's worth it and they can show them some massive The other thing is in those situations, all those guys are looking to hit a sale in year 5 because they have to hit these targets for their investors.
For their IRR to get to where it needs to be.
Right. Versus us, it's very straightforward, is that this is what you're going to earn out. And if we see the value in refinancing it like we did on White House, we might hold this for a longer period of time and have a fatter payday 5, 6, 7, 10 years down the road. And we're going to play this long game.
I mean, I'm guessing that your game plan, to protect your investors first, I'm guessing, you can tell me if I'm wrong about this, is to try to get their capital repaid as quick as possible in order to pay them off. There's no 8% pref. And as you can see, that pref payment is the same amount as your mortgage, right? It's half the amount. But, since the interest rate's double for the most part, you want to get that out of there.
Well, and there's no principal pay down there on
Chris and I are looking at a deal here to potentially lend on, and it's a big loan locally that they want to refinance because even paying a double-digit interest rate of return with us is still better than their current setup with their lender, with their preferred investors, with their limited partners, and then their LPs are get paid off. So there's a double whammy, right? Like you don't have that pref anymore, but you also satisfy your investors.
Well, let's switch deals here real quick, and I could write it up on the board if we needed to, but White House, our 76-unit apartment building, which we've case studied in the past, maybe we should have done a follow-up on this now thinking about it. However, what we were able to do is not only were we able to refinance it in 18 months, we were able to take out our $1 million of investor money and take another $1 million out above that and still have the same exact payment that we had when we were paying $1 million less mortgage, $1 million less in equity, and paying everyone their money, which, again, that's the power of the interest rate. That's the power of increasing the equity and returning it. And then that turned into an IRR of expected of 16 or 17%, turned it into 23, 25%.
Because it happened quicker.
Because it happens quicker.
Yeah, so when you can have your exit as quick as possible to your investor group, exponentially though, a few things. We can talk about that. The benefit of doing that and paying that investor off that much quicker is multiple things. Number one, their return skyrockets.
Correct.
Number two, they have that capital back immediately that they want to redeploy into your next opportunity. And they're raving about it.
They're telling all their friends.
They're raving about it. So what Ian just kind of said is, hey, well, we took out $2 million and our payment stayed the same. No brainer. So that's the first part. That won't always happen, but no brainer, right? $1 million went to our investor group, and that investor group, now has $1 million of dry powder to put back into another opportunity.
Not to mention Dan and myself have additional capital.
Now you have that $1
deals.
million that you redeployed into another deal, and as refinance proceeds, so it was tax free. Obviously that will go against your basis when you go sell the property, right? So it'll get recaptured. But obviously, hopefully, you sell it for more than your your current balance,
Sure.
and it's okay. You'll have that. But
right.
But that's the point. You want to get these things off the books as quick as possible, at least with the investor group, because your investors are always most important. You don't eat until your investors eat.
Well, let's take it back down to simplistic form. I know we got a few minutes left, but and I don't want to say it's simplistic like that. That it's not trying to be rude, but let's take it back to single family. It's the same thing we did in single family. I would go to Jason and Chris, or no offense, but a few other hard money lenders in the marketplace. I would get some money.
Offense taken.
Yeah. But you knew what we were doing, and you guys couldn't service everything that we wanted to do. But in the end, we would go to Jason and Chris and a few other hard money lenders. We would get the majority of the money. Then either myself and Dan or a few of our close friends would put money up. We would build the properties out. I'd turn around. We would refinance them as fast as possible with the bank to get long-term debt, and we would rinse and repeat. Chris and Jason love me because we're able to do multiple deals. Every 6 months we're turning that same money for them. Our investors love it because they're getting a consistent 8% on their money, and then our bank loves us because we're bringing new deals in every single time and new deposits for them. So it's this cyclical thing that happens with everybody, and that's again that speed to market, whether it's real estate and stabilizing your property, flipping the house, a new business venture, whatever it is. Speed to market's always going to win. Get it done.
And let's. I'm going to do one more follow up on that, then we can move on to some execution stuff. But it's all about ease of getting these things done. A lot of times, I think a question that someone should have here in the audience would be well, if I have a deal, should I structure it that way? It's 35% equity and then 8% pref. And the answer is it depends on how you want to do it and how you want to structure, how you want to micromanage. But it also comes down to supply and demand of how it's set up. Here's the thing. Could you do this at a 6% pref?
Sure.
My opinion is yes, you could. But I also, because I've raised lots of capital over the years, is I don't think you're going to have the right demo. Right, and it's got to be a win-win for both sides. If that investor if they feel like they're getting a short end of the stick, they're not going to reinvest. This is a long play. I mean, everybody, Grant Cardone, everybody at any level raises capital, and they do what's easier, that works for their model, and that their investor group is making money.
Well, and I would say, and I know we want to move on, but let's not glaze over any of this. Is that's what works for my investors. I had a long conversation with one of our other close friends, and I said, his name's coincidentally Jason also, and he's like, why are you fighting inertia? I said, because I don't get it. I can't do it the way these other guys do it. It doesn't work for me.
Because he wants you to charge fees?
Yeah, because he's like, dude, it takes time, energy, and effort to put the deals together. You should monetize yourself. That's how you build staff. That's what all these guys are looking. They're looking to build these massive investment firms. And he doesn't syndicate deals. But in the same sense, he comes from that traditional background. And he's like, why are you fighting inertia? Why are you fighting the marketplace? Why don't you just do it the every way? I was like, you know what? It doesn't work for me.
None of us have ever done anything the way that other people do it. We do it our way. And here's the other thing, just so people understand. A lot of people will give potentially more equity up front.
Correct.
Which is kind of a fake number until there's a capital event anyway.
Sure.
But anyways, they give more equity up front, and then they have fees. And those fees come first. In Ian's model, which I like, which is one of the reasons we've invested in those, and it's kind of similar to how we raise capital as well, is, the investors get paid.
You don't get paid, and I don't get paid unless we perform.
Yeah, exactly.
Right? Like if a note goes bad on your books, you're not getting any money.
Yeah, of course. Of course.
I mean, and in the same sense for us, if a deal's going sideways, our investors are always getting paid first. Their clock is always running.
Yeah.
Versus our clock is, well, we need to perform. So.
Yeah. No, of course. It's the same thing. All right. Anything else on the capital side, or should we talk about execution? I mean, let me just end with this. Like, was it easy to raise the money, or were you a little scared?
I was completely scared. It wound up being easier than I thought in a roundabout sense, but it was also difficult because I made it difficult. I said, well, this is a large amount of money, versus me saying, you know what, it's no other than any other deal, and I should have went in a little more like not as stressed, but dude, pounding for dollars, it's work,
and you make it work.
Yeah. In the end, dude, it wasn't as bad as what I thought it was, but it wasn't as. It's a little bit of both.
In real time, you're nervous. When you look back, it was like, yeah, it wasn't that bad. Right?
Well, yeah, and someone brought us. Actually, we're looking at this other deal that's about the similar size, and I'm like, I got PTSD, but I'm like, I know we can do it, right? Like,
yeah.
So it's.
Listen, I mean, we started out with no capital when we had to raise money for our lending company, and we had deals that we had to close, and. Yep. You make it work, right? Like, you make it work. That's the best time to do it. You go find a really good opportunity, and you figure out a way to make it work. And you'll know real quick if it's not a good opportunity, because if it's not a good opportunity, no one's going to do that deal. And your brand is tarnished, and you're good luck ever trying to raise capital again.
Yep.
Like, what we tell some of our partners in other markets, hard money bankers markets, is like, you can't have any defaults. Like, you're new in this market and you're raising capital. You can't have defaults.
Yep.
If you have one default, your investors aren't going to reinvest with you. Like, you can't put a capital investor or a syndicate, any investor into a deal that's going to have any challenges or hiccups at the beginning. Challenges and hiccups are fine. Right. That doesn't mean anyone's losing money, but like, they can't have any volatility. It's got to be freaking clean cut, easy. Right. Make it simple. They want to reinvest. So I know currently you're kind of in the execution stage. When did you buy this property?
We bought it November 5th.
So, and
we're
in the middle of March.
Yep.
So, your execution time, right? You're trying to execute and kill it on this thing right now, because that's the next step. Have you been doing the improvements, I'm guessing?
Yeah. So this size deal, it doesn't move like a jet ski. It's not a single family house. It moves more like the Titanic. So things take time. National vendors take a little bit more time. So you getting signage right, getting the tenants right, getting everyone notified, getting the management side of things. We're also working through a property manager who we've never used, so we're learning their process. We have a marketing company. We've never used their process before. So there's some learning curve on a few of those things. Holistically, overall, yes, improvements are being made. The next round of large CapEx of ordering doors, lighting upgrades, and all those other good things, it takes time to put these bids together, especially on 250,000 square feet, 3 properties. I mean, that is very large. Your a lot of little mom and pop sites are 20,000 square feet.
And let me ask you a question, because I know that you're not local to there.
Yep.
Do you recommend people only buying this stuff local, or like, has it been harder that you're not there, or it's irrelevant, it doesn't matter?
I would actually say it's the opposite. It's almost better that we're not there. Like, during stabilization, it sucks because I can't just get in the truck, drive down there with Dan and Ryan and be like, all right, screw it. Like, we're going out there for a whole week to get everything knocked out, right? And we got to dedicate time, and it's time away from our current business. So during stabilization, it sucks. Long-term operation, with the right people in place, you can operate these things from anywhere in the country better than you could single-family and potentially multifamily.
I was going to say, what about multifamily?
Yeah, multifamily, there's a lot of good property managers out there nationwide if you're willing to utilize vendors.
But they still got to give you your approval for anything above a certain amount, right? And
yeah, I mean, when you're talking about larger multifamily deals and being sophisticated about it, there's some really, really good operators out there. Again, because the REITs are in there and they've created this marketplace and they've created vendors that they want to utilize. Whereas in this space, it's still going through a mom and pop transition, and the REITs are the only property managers because they've figured out how to manage local to them. So there's.
Well, let's talk about property management, and I'm skipping ahead a little bit because I know part of this, but you had a full-time property manager that costs a good amount of money.
Yep.
That's handling that. So you have a property manager, then you have an on-site person.
Boots on the ground.
You have boots on the ground as well. But you're considering taking property management in-house.
Yep.
What are the reasons for that?
Some of it is, again, it goes back to control and the speed, right? Like, being speed to market, whereas I'm operating through a third-party vendor who we thought our goals were aligned, and I'm starting to think that our goals aren't as aligned. They're going through a major growth spurt. I'm not really willing to wait for their growth spurt and help them get through their growth spurt.
As you as a crash test dummy?
Right, whereas I could just be like, you know what, if I'm going to help you with all this shit, I might as well just help myself, because we were going to rip the Band-Aid off at some point and fully integrate in-house. But, we're not just ripping the Band-Aid off and going for it. We're also interviewing additional property managers who we seem to like in the marketplace and seeing what the best bet is. Look, what we have is working. It's just not working to the way that it makes my life so stupidly easy that I can literally just concentrate on raising capital, finding deals, and doing the CapEx, which our team does the best. The internal day-to-day operations we can manage, but it's going to take away from everything we're doing. We are in the process of selling our single-family properties that might free up some time to allow us to grow this team, but we're also not mentally ready to do that. So we're viewing a few different options, because in the end, when you're responsible for other people's money, you need to do the most diligent thing that you can for them, not only for us to make money, but for your investors to make money. And if there's a better solution in the marketplace, let's identify it.
And also, to relate this to some of the smaller stuff as well, I think a lot of people come in, especially like savvy investors that want to be active. It's like, hey, I'll just autopilot this with a property manager. And that sounds great on paper. And I'm not saying that doesn't exist, but unless it's perfect, like we did the same thing. We went in there and we were like, hey, we want to get a property manager. We got a property manager. I couldn't get the data I needed. It was awful.
Exactly.
And then anything that was like turnovers, maintenance calls were coming back to our desk anyway, so it was a pain in the ass. So then we took it in-house. Didn't like that either, which is one of the reasons we sold our portfolio.
Yeah, but you could, and I was familiar with your process then, is like you could actively manage Julie or whoever it was in your office at the time. You could get up out of your seat.
Julie was fine, actually, with it. She was
you
good.
could get up out of your seat, walk across your office, and go, Julie, what the fuck's going on?
I know, and that's what I like. Yeah. And that's the reason on my lending portfolio, we lend locally. All these freaking lenders, these newer lenders, like, I'm just going to outsource it. And it's like, it's not that expensive. I don't have to hire a controller. It's like, what are you talking about? Then you're not even going to know what happens. When was when one of your capital investors says, hey, what's going on with one of my deals you don't freaking know?
Right. Oh, yeah.
You're done.
Yep.
You're done. And it's the same thing. So when you're responsible for other people's capital, which as you grow as a business owner, you probably are, it's not a scary thing, but you got to be responsible, and that money's more important than yours.
Yeah, one of the scariest things that happened to us was I had a fellow storage investor who as well as a potential user of this property management company, and I showed up and there was a major inherent issue when I got there, and it was like thoroughly embarrassing. Could you imagine if I had said, Jason, John, a few other guys, like, jump on a plane, meet me down in Baton Rouge, let's go out to dinner, and I'll show you the properties, and then like everything was inherently wrong? Like, that would be scary to me, right? So in the end, like, you need to know that you're putting your best foot forward. And if your vendor's not doing what they need to do, and we talk about it all the time, is like, our job is now transition from managing the day-to-day to actively managing our manager, right? And that's a part of our role. And that's what we do good. I don't want to call us mid-level managers, but like, if we have the right vendor in place who's willing to listen, we can actively manage them. However, if they're doing their own thing and they're rogue and they're not fixing the same problems that we're having over and over again, well, that's when you need to change something. The good thing about storage is it is forgiving. We're still profitable. It's just not going the way that makes it seamlessly easy for us, and that's why we're looking at resolving that.
So I know we didn't have a chance to go through too many questions, but and I know some questions have come in. If you have any questions, feel free to comment them below, and we'll get to them later tonight or tomorrow. Little housekeeping stuff. Next meetup is Wednesday, April 20th, same time. So, make sure they're there. One day soon, maybe we'll all be back in person together. Being fully transparent, running a meetup group is, sometimes a pain in the neck, and it's kind of hard to coordinate and things like that. So if anyone has any ideas related to topics, speakers, guests, things like that, one of the segments that Ian and I have considered now that we have a podcast studio and a video studio is potentially bringing people into the office and doing kind of
Almost
case studies. That's probably a good way to do it.
like a one-on-one coaching session right here.
Let's bring that back up. Yeah, so we do one-on-one case studies or with a small group. So just think about it. If you have anything you want to comment below, or reach out to us directly, jason@hardmoneybankers.com, ian@equitywarehouse.com. Hopefully this brought value to you. This is always a fun topic, anything case study-wise. And we'll see everybody on Wednesday, April 20th. Check you later.